has cash confirmation. Your first busy, short 5 to 15 minute podcast. Debt is more like this is the audit. This is the audit. To get stuck in your work. This is the AuditCast. Thanks for listening.
All right, welcome back, everybody. So this is the Estimates podcast. Now, just to clarify, this is the shorter version. We have a longer, more detailed. We'll go into just more around auditing estimates and all the different components. But for this one, this is our short overview to get you into your testing. So before jumping in, just want to say, please rate, review, subscribe, whatever you can do on the platform you're listening to. That's a really big help. We're on Stitcher, iTunes, our website, YouTube, you name it. So on any of those platforms, if you could please do whatever form of rating and reviewing they have, that is a big help. Thank you. Okay, so getting into it, I want to talk about how to audit estimates. So before we kind of get into the auditing component, I think we should define an estimate and then get an example that we're going to use to work through for the remainder of the podcast. So the PCAOB definition is this. An estimate is an approximation of a financial statement element, item, or account. What does that mean? I call it a guess, right? It's just an estimate, an unknown, uncertainty, whatever. Here's a couple examples, right? First of all, most accounts, most estimates have some sort of fair value component. So you think of goodwill, net realizable value of inventory, or the allowance for bad debts. Now, the allowance for bad debts is a pretty simple one and pretty straightforward, but I also think it's a good example for today. So that's what we're going to use. So then, first things first, within auditing all estimates, within all estimates, there's kind of three main factors. There are data inputs, a calculation model, and then assumptions or judgments. We'll just call them assumptions for right now. So those are the things that we audit to. So we audit the inputs and data. We verify the math accuracy of the calculation and verify that it's appropriate for the purposes of the analysis. And then we critically evaluate and corroborate assumptions. So just don't forget that, because that's kind of where you can get yourself out of the forest, let's say, when you're kind of lost in the trees of like, where am I? Just think, am I in the input section? Am I in the calculation section, or am I in the assumption section? And then the different types of testing will be a little more evident when you can define that. So, jumping into our example of bad debts. Let's go through this simple example of a bad debt expense. Let's say that a company has a bad debt reserve, which is based on aged receivables. So let's say 0 to 30 days gets no reserve, and then 31 to 60 days gets 2% reserve, and then 61 to 90 days gets 4%, and then anything older than that, let's say, gets 25. The numbers don't much matter here, but I'll explain kind of what those signify here shortly. So, to test the input or data component of that, what we can do is, well, first of all, to inventory kind of what are the data components here. We have the aging report. That's your biggest piece, right? That's your really only known or factual component of the analysis or of the reserve itself. So, that said, if it's simply just this aging report, you kind of can do two quick things. One, you can tie it to the GL or into your AR recon or whatever version of the trial balance you can get to. So that gives you a completeness component. But then you want to also test the aging report for accuracy in what we'll call the buckets. So you'll do like a bucket test, meaning the company's reserve is broken, into these different components of 0 to 30 days, 31 to 60, 61 to 90, and 91 and over. So what you're going to do then is test a sample of invoices against that AR aging report to make sure that the that the invoices noted in each aging bucket are appropriate. Now, you may have ITGCs, you may have key reports, you may have your some sort of IT team testing the key report around that, and then you might be able to bypass some of those components. However, that gets into some trickiness because then you're talking about data controls rather than input controls. I won't go into that too deep. If you want to check out my episode on IT, key reports, ITGCs, etc., that can help clear the air there. So, back to what we were talking about. We just talked about how to get comfortable around the data component of our example estimate here. So now let's go into the calculation model. So we've verified that the aging report is both complete and accurate, right? One, by tying to the GL, and two, by testing the buckets of the report. Now, the calculation model is likely very simple. It's likely just the aging report with another column multiplied by the specific aging factor that we discussed earlier, the 2%, 4%, or 25%. So, in verifying that the calculation model is mathematically accurate, one, you're going to verify, A, that the formulas are right. Is there a multiplication formula there? Is the formula dragged all the way to the bottom of the report, etc.? Real easy stuff. And then also, are the appropriate factors applied to each bucket, i.e., if there's a 91 and older invoice noted on the report, is it getting a 25% factor? If it's not, then there's likely some problem with either the sum ifs or VLOOKUPs or pivots or however they're doing that. But that piece is pretty straightforward. The second piece really to think about when you're evaluating the calculation model is that calculation model appropriate for the purposes of the estimate? Meaning, is this really the best way to achieve the desired result? And in this case, it's pretty simple, right? If you're just trying to bucket aged receivables and multiply them by specific percentages based on predetermined criteria, then you're good. Then it's, like I said, you just add a column to the report, throw in the multiplication factor, and extend, and you're done. Now, this gets a little trickier maybe when you're talking about actuarial science or things like that. And so that's a little beyond the purposes of this podcast, but in most cases it's relatively straightforward that the calculation model is appropriate. When you start getting into really technical modeling techniques, that's probably when you're going to have some sort of expert helping you anyways, and they can assist in determining whether or not that's appropriate. So lastly, now we go to the assumptions piece. So the assumptions in an estimate, right, are the critical judgments. They're kind of the soft pieces of the estimate, and there's nothing to really nail them down to. It might be management determining, or management, using data either internally sourced or externally sourced in order to provide that as a soft input into the assessment or calculation. So in the case of our example now, we have the assumption that these factors being applied to the aging buckets are appropriate. So let's think about this. When we talked about earlier, what we talked about earlier was that 0 to 30 days old, invoices that are 0 to 30 days old get no reserve. 31 to 60 days get 2%, 61 to 90 days get 4%, and 91 and older get 25%. So if you think about that, that should be based on some sort of logic. Ideally, that's going to be based on historical, actual results, meaning that for, if the company looks at the last 5 years of receivables turnover and collections data, they might note that anything that's 0 to 30 days generally doesn't become uncollectible, but they might see that around 2% of 31 to 60 days is uncollectible, and so on and so on. So let's think about how that translates to an assumption. That is using the assumption that past performance indicates future results, right? So they're saying that historically we've seen this, so therefore we are going to apply that to our current our current aging report. Our role as auditors then is to corroborate that assumption. So there's going to be a number of techniques you're gonna do there. One, management in this case really should be doing some sort of annual or some version of a periodic review to see if these numbers are accurate. Now, they may just use blanket numbers because that may be the industry average or industry standard, excuse me. And so that can be okay, especially in an aging calculation. But what we would need to do is corroborate that by looking at other companies in the industry or collection rates that may be published or something along those lines. But if it's simply internally captured data that they're relying on to develop these factors, then we really should be looking at whatever analysis they put together in order to corroborate. Now, it's going to be a lot of internal information, so we might not be able to audit to third-party data, but reviewing management's assessment there and their analysis that supports that, tying out what data we can to tested data, and then if in fact there is new information that wouldn't be subject to testing either in previous audits or in current audit, then we should consider doing some testing there. But remember, the whole point is to corroborate those factors, and that's the really big assumption that goes into this simple example. So realistically, I don't know how much time we've got here so far, a few minutes. That covers the briefest overview of how to test an estimate. So you can take this and apply it really to anything. If you look at, if you go to Goodwill, Goodwill has a bunch of moving components, and you can actually take a look at my other episode on Goodwill. But realistically, some big factors going into a Goodwill test are testing management's cash flow projections, because cash flow projections go into the evaluation of Goodwill for each segment. So a lot more going on there, but it's still ultimately it's the same concept where you're going to validate the known factors, which is going to be the data or inputs, and you're going to validate that to tested data or test them. You're going to test the mathematical accuracy. Usually an expert will be involved at that point, because a lot of time management utilizes experts to put that together, and then therefore your auditing firm will usually engage another expert, but nonetheless somebody's going to be testing the math. And then lastly, you just evaluate the crap out of all their assumptions, which there's going to be many. There's going to be many assumptions around revenue growth rates by segment. There's going to be terminal rate assumptions. There's going to be uncertainties that may be built into the forecasts. The triggering event evaluation to even begin the Goodwill process is going to be full of assumptions. So realistically, you break the audit of estimates down into 3 components. Like we said, the inputs and data, the calculation model, and then the assumptions or judgments. And you test to those. It's pretty straightforward after that. Now, like I said, I'm going to have a much more in-depth version of this to go into sensitivity analyses, management bias, the planning component of estimation uncertainty, breaking out of critical assumptions versus non-critical assumptions. And I'll also have an episode on Goodwill, amongst other things. So if that's the specific estimate that you're auditing, please check that one out. But that's basically it. So happy auditing, everybody. And again, please rate, review, and subscribe. And I look forward to hearing any feedback. Take care.
This is the AuditCast. Thanks for tuning in.